We'll be having a robust discussion on the Finance Act 2021 implications for banks, insurance, other financial services, and the capital markets in general. To take us through the session is someone who needs no introduction. Kenneth Erikume is a partner here at PwC with many years of experience in this industry. Just to let you know that we want this to be very engaging. Please let us know at any time when you have questions. You can do this by, raising your hand. You can do this by typing your question directly on the group chat right there on your screen. You can send the question generally to everybody. You can send it to the host. You can send it to the presenter. Or like I said, you can raise your hand and you'll be allowed to speak. You can't unmute yourself directly, but as soon as you raise your hand, the admin will send you a prompt to unmute so you can talk. Please let us have your questions at any time. Thank you so much. And at this time, I'll hand over to Kenneth, who will be supported by our senior manager, Babatunde Olani, and the rest of the team. Thank you so much.
Right. Thank you very much, Emeka. And good morning, everybody. Welcome to this engaging session on Finance Act 2021 as it relates to banks, insurance, and other financial services industry. So I'll take the next 30 minutes to present on, the Finance Act changes, and then I'll take the next 30 minutes or 25 minutes to have a conversation before we wrap up. From a sectorial perspective, the banking and financial services industry continues to be a major contributor to the Nigerian economy. In Q3 2021, the sector growth was 20% higher than the previous year, and the contribution of the sector to GDP increased by 3.16%. The restructuring of the Nigerian Stock Exchange has been completed, the so-called demutualization process, and Nigeria Exchange Group PLC has now been formed and is operational. So this sector, was identified in the National Development Plan, NDP, which covers the government's plan from 2021 to 2025. The NDP is seeking to unlock value, essentially from the private sector. And financial services was identified as a key sector that would, be instrumental for this. First, in terms of unlocking credit for the micro, small, and medium enterprises, also in de-risking that sector, and in terms of even funding the investment that's going to happen over the next 5 years. From a landscape perspective, fintech and payment continues to be a very important bit of this sector, especially with emergence of what I call, the new area around payments and new companies emerging in that sector. And Nigeria, obviously, with the population and the potential for subscribers, has seen a lot of activity in that space, attracting investment from across the world. Of course, this has necessitated a rethink, particularly in the banking sector, around the corporate structure, as banks begin to seek to restructure in order to play in that sector. A few banks have now looked at the holdco structure, which was adopted only by a few banks initially in 2011, thereabouts. Of course, the Africa Continental Free Trade Agreement provides opportunity in this space. One of the sectors where Nigeria has been able to play, at least Nigerian owned companies have been able to play in Africa with a significant amount of success, has been in the banking sector especially. So we see that, the AFCA would provide additional opportunities, especially with the, implementation of the Pan-African payment and settlement system, which allows for, customers and vendors in different jurisdictions in Africa to be able to make payment, get it settled and received in another country, without conversion, essentially making payment with local currency, and the supplier also receiving their own local currency. So that would be massive in terms of unlocking value from an African perspective. So this is just the landscape. From a landscape perspective, there's a lot of opportunity. However, the Finance Act 2021, seeks to enable, the private sector and businesses to be more efficient. But one of the things I would say about the banking and financial services industry is that, that objective, is there. But, when you look at a lot of the changes, it looks like most of the objectives are around raising revenue for government. And this is not, it's not surprising, considering the fact that in the past years, Nigeria has been unable to raise its tax to GDP ratio. Similarly, apart from raising the tax to GDP ratio, there's also the issue of meeting the budget deficit, which has consistently been over 2 years, about 6.4 trillion naira in each year. When you look at the performance in 2021, even though a budget deficit of 6.4 trillion was budgeted, when you look at the performance up to November, it seems like in terms of revenue performance, the government was doing about 74%, but in terms of expenditure performance, it was about 94%. What that means is that the budget deficit, which was, initially planned, would expand even more. And that's what you've seen in terms of government to plug those gaps. I think there is a hand, so maybe I'll pause and take the question from that hand. Okay, if that question is not coming through, I'll continue. There'll be a time for that question to come through. So, what I was saying is that, government would continue to borrow if the revenue does not essentially meet up with expectations in the foreseeable future. So a lot of the changes you'll see in the financial services sector is largely on revenue generation. And this is not surprising. I'm sure as a player in this industry, you would have noticed that there is an assumption from government that this sector is liquid. And on the that is liquid, there is potential for easy revenue generation. But what we have advocated in the past is for the expansion of tax net as against targeting the same taxpayers to generate revenue. Because at some point you can no longer squeeze them. So we need to anticipate expansion of the tax net. Otherwise, government will continue to target this industry. The key in this industry are number one, the capital gains tax. So from a capital gains tax perspective, there's now an introduction of CGT on the disposal of shares. As long as the disposal of shares in any 12 consecutive months is at least 100 million, the proceeds is at least 100 million. So what that essentially means is that if there is an investment in a Nigerian investee company for capital purposes, and those shares are sold, after 1st January of 2022, and the proceeds exceed 100 million, it essentially means that you would have to pay capital gains tax on the difference between the sales proceeds and the historical cost of the shares at 10%. So the difference between the sales proceeds and the historical cost will give you the gain, and that will be taxed at 10%. The change of the rule was actually to delete the previous exemption, which exempted Nigerian government securities, stocks, and shares from capital gains tax. The only exemption that was therefore retained was the exemption for Nigerian government securities. So if you continue to dispose of Nigerian government securities, there will still be a CGT exemption. This implies that for disposal of foreign equity investments, so if a Nigerian company holds the shares of a foreign company, that it will be subject to CGT without any capital, without any threshold. So the 100 million threshold only applies when it's the disposal of a local company's shares. There are also questions around what it means for the new LLP structure, which is the limited liability partnership. Because, the limited liability partnerships are not really companies. However, their investments are like investing in the LLPs, like investing in a company. You hold units. What that therefore means with this change is that if you're disposing of the shares in an LLP, you could effectively be subject to capital gains tax without any threshold. So those are some of the things banking and financial services companies should watch out for in relation to this change. Another change that has come in is a 25% increase in the rate of tertiary education tax. Used to be 2%, it's now been increased to 2.5%. That change of 0.5% could be massive in terms of impact. And the reason why it can be massive is because tertiary education tax is computed on assessable profit. And assessable profit is before losses and claim of capital allowances. So the impact could be massive because in the banking and financial services industry, many of the companies' profiles had significant tax-exempt income, which meant that historically they were coming with carry forward of tax losses. Now, with this change of 0.5%, those tax losses will not provide a shield, against tertiary education tax. So the change or the increase will lead to a significant impact in terms of taxes. There is also the NASENI levy, the Nigerian Science and Technology, levy, which has always been there since 1992, I think. But what they have done with the Finance Act, of course, nobody paid this levy historically. But what they've done with the Finance Act is that they've limited the scope of the companies. Of course, banking, has been identified as one of the industries targeted by this levy. And the levy is 0.25% on profits before tax, as long as the banks have a turnover of 100 million naira, which is nothing. So even microfinance banks, would clear that turnover. So it's going to impact on this industry going forward. There's also, in the Finance Act 2020, there was a reduction of the minimum tax rate for 2 years to 0.25%. Now, there was I wouldn't know whether it was an error, but, the amendment then was that it would apply to financial years 2019 and 2020. So when companies were filing their minimum tax return or their CIT returns, a lot of companies went back into 2019 to reduce their minimum tax rate from 0.5% to 0.25% because the Finance Act 2020 already allowed them to do that. There was massive resistance by the FRS, and the FRS said then that companies could not go back and change what they had filed because that would mean a retrospective application of the law. In order to find some balance between this dispute between companies, the ambiguity in the law, and this interaction, the Finance Act has now been amended in such a way that it says that companies can claim that 0.25% reduction in rate for 2 years between 1st January 2019 and 31st December 2021, any 2 consecutive years. So as a bank or an insurance company or a player in the financial services industry, you can apply that minimum tax rate either 1st January, either for the 31st December 2019 and 31st December 2020 financial years, or 31st December 2020 and 31st December 2021. What it would require is for you to do a simulation of the impact to then determine which one gives you the better result and then file on that basis. There was an amendment in Section 55 of the Companies Income Tax Act, which essentially, you need to also watch out for in relation to this. It says that if you do not file your returns within the statutory timelines, any relief you've sought will, be considered part of your penalties. So it therefore means that if you file the returns late, you could potentially lose the 0.25% minimum tax rate and be assessed to 0.5%. I see Babatunde's hand up. If you have a question, please interrupt me. Otherwise, I'll go because I need to finish in the next 10 minutes.
Yes, Kenneth, and just ask you to just touch on some of the, should I say, perspective that taxpayers have brought up as it relates to Nasani levy and the retrospective application. Just as you mentioned, the TAN Act that came in 1992. So, from a taxpayer's perspective, do you see the FIRS raising assessments for periods prior to 2022 year of assessment? And also to remind the guests as well that they can please put their questions in the chat box whilst Kenneth is providing his insights.
All right, thank you very much for that useful question. So the Nasani levy, all the way since 1992, never enforced by government till now. And then you also have the Nigerian Police Trust Fund. The Nigerian Police Trust Fund came up in 2019, but it did not have administrative provisions. So it didn't say who is supposed to assess, who is supposed to collect. It also did not indicate the due date for filing. Now, what we've seen with the Nigerian Police Trust Fund levy is that in the Finance Act 2021, it's now been clearly indicated that the provisions of the Companies Income Tax Act in relation to assessment, collection, enforcement, and so on would be applied on the Nigerian Police Trust Fund. Now, what that effectively means is that FRS is now empowered to administer and collect. Since the law was already operational since 2019, if I'm not mistaken, it means that the FRS could go back and collect the taxes even for the previous years. They could come up with guidelines for the payment of those taxes from 2019. And that will not be retrospective application because the law already provided that companies had an obligation to comply with this law. So the only difference is now government is now saying that the person you pay to or the person who you administer is the FRS. For Nasani levy, the situation is a bit different, right? Because using the doctrine of legitimate expectation and on the basis that it was never administered in the past, one could take the view that to apply these rules strictly, especially because of the punitive rates and the fact that it's been alive for a very long time. Applying it to previous years would be against the principle of legitimate expectation. And so from that perspective, I do not see the tax authorities going backwards, but they would apply it going forward, very likely applied going forward. All right, I'll jump to the last point on this slide, which is on the claim of capital allowances. If you remember, in 2019, 2020, there were amendments to give effect to the fact that you cannot take a deduction for expenses that relate to tax-exempt income. So if a company made both taxable income and tax-exempt income, there was an expectation that there had to be an apportionment of some of the company's expenses to the tax-exempt income. In this industry, it how that is applied in practice is a bit inconsistent, right? Because we see different bases of application. Some people apply just direct cost and then they don't apply anything else. Some people do pro rata. Some people don't do pro rata. They say, well, some of the funds we use to generate the tax-exempt income also come from shareholders' funds. So they do that allocation. So inconsistency across the industry. But that has been the case for overheads and admin expenses. Now, the tax authorities have come up with a rule for qualifying capital expenditure, which is your capital allowances, to say, some of your capital allowances needs to be allocated to tax-exempt income. And, as long as you're generating more than 20% tax-exempt profit, you now need to go into this rule where you do a pro rata apportionment. And there are different interpretations I've seen across board. And I think, this sector, as a company, you need to look at the various interpretations and take a position on some of these matters. For example, some practitioners say, on qualifying capital expenditure incurred before 1st January 2021, you should not apply this rule. You only apply it on expenditure you incur after 1st January 2021. Even though I don't subscribe to that interpretation, there is some logic to it. So companies need to assess that. In addition, some people say, well, which capital allowance did I apply to? The capital allowances brought forward for the 2022 year of assessment, all the capital allowances brought forward, I will not apply the rule. So I would apply the rule only to the capital allowances that have been generated effectively in my 2022 year of assessment computations. And then, there are interpretations also around, should I apply it to the total pool of capital allowances, or should I apply it to the capital allowances which I'm claiming for the year? And all of these things are quite technical, so companies would have to assess them on a case-by-case basis. Babatunde, I see your hand is up, so we can please go ahead.
Yeah, thank you, Kenneth. I think whilst you were speaking right on this technical area of the Finance Act, a question came in, right, particularly as it relates to this section, whether it's possible that you just give a simple illustration to illustrate the point on capital allowance.
Okay, so the problem with this is that it's going to take me a very long time. But the principle that they've taken in the law is that if you have income of 100 and let's say 30 of that 100 is tax exempt income, then you're supposed to do this analysis of your qualifying capital expenditure. So once your tax exempt income is more than 20%, you're supposed to do this analysis. But then there are several interpretations and permutations. And what we will see, my prediction is that you will see inconsistency in terms of application. Because the law actually says that what you prorate is qualifying capital expenditure. Qualifying capital expenditure is the total investment amount you incurred on the asset. But you cannot prorate the asset on a year's profit, if you see what I mean, because you're going to be using that asset over time. So this is one of the reasons why you see different applications, because some people will say, it is only the assets that you acquired after this rule came into place that you apply the rule on. So any asset you incurred before then, you will not apply this rule. So there are people who will take that view. There'll be some people who take the view that it is only the capital allowances that you generate effectively from, when I say generate, that you compute from 1st January 2021 financial year, which is 2022 year of assessment, that you need to compute that proration on. And then you see some people say, well, am I applying that ratio on the total capital allowance pool, which is capital allowance brought forward and capital allowance computed for the year? Or am I applying the ratio on the capital allowances I'm relieving for the year? So these are the reasons why I say there will be several permutations. For me, I think reading section 31, the rule should actually be to apply that ratio on the capital allowance that will be claimed during the year. And there should be no distinction between, the qualifying capital expenditure that you incur, from now and what you incurred in the past. Because as long as the asset is still in use, that asset remains qualifying capital expenditure. But, at the end of the day, companies need to assess various interpretations, various permutations, and see which one gives them the best result with sufficient technical backing. I think that's the point we can take from here without going into too much analysis. Okay. All right. Now, some of the subsector specifics that have arisen is, the first one is the penalty for failure to submit quarterly returns to the FRS. This is for banking. For, the threshold for transactions increased to 1 million. And the penalty for not complying with this has also been increased to 1 million for non-compliance for those quarterly returns. So this can be a massive penalty for banks, if, the quarterly returns that requires banks to provide information from time to time on a quarterly basis to the tax authorities, there's default. There's also the requirement now for banks to submit quarterly returns of all new customers. So no longer monthly returns, which makes it a bit more palatable for banks as against providing monthly quarterly returns. The changes in the insurance industry. The first one is that, previously there was a section 16 that had its own minimum tax rule, and then you have the section 33. So there was an ambiguity on whether you would apply, whether insurance companies had to apply minimum tax under section 16 and section 33. Of course, the industry took a position that once you've applied the minimum tax rule in section 16, you don't need to apply the minimum tax rule in section 33. But that has now been harmonized, and everything now sits nicely under section 33. For personal income tax purposes, previously, on a preceding year basis, one could take a deduction for premium paid for life insurance and deferred annuity contracts, both for yourself and for your spouse. The change that has now been introduced because of some questions around whether those deferred annuity plans were actually insurance plans or were just savings, right? Was that in order to avoid that ambiguity, they've removed the deferred annuity plan from their exemption. So if you're doing, an insurance savings scheme, right? It would no longer qualify as a deduction either for you or for your spouse. So that's one of the changes that has come through. The other one that has come through is the capital requirement has replaced paid up share capital in the Insurance Act. And this is important for the purpose of future minimum capital changes in the insurance space. As there's been some court order restricting the NICOM from implementing the increase in minimum capital in terms of the minimum capital requirement. But now there's now a definition for minimum capital requirement, which would also cover retained earnings, which is actually useful for insurance companies because now they can capitalize with retained earnings. Now, for the capital markets, real estate investment company now includes unit trust for CI purposes. So when the exemption for real estate units, real estate investment trust or REITs has now been expanded to cover REITs also. So REITs would also be and REITs would also be transparent for CIT purposes. Withholding tax on interest earned from unit trust will be treated as final tax. The mutual funds and the unit trusts historically had some controversy because when they receive the income for the benefit of the unit holders, CETA actually used to say that those incomes will be subjected to tax as if the unit trust is a company. And of course, distributions will be subjected to withholding tax as if the unit trust is a company. That went against the trust principle because the trustees hold the assets for the benefit of the beneficiaries, in this case, the holders. So this ambiguity, I wouldn't call it ambiguity because the industry took a position, but in order to align with the industry practice, there's now a change which has been applied on that. And then in 2019, obviously, if you've been following the trend, the VAT exemption on capital market fees was expired. And then effective from 2019, there's now VAT on commissions earned from capital market transactions. There's also the increase in the registration fee of capital market operators, which impacts them, as well as all these Finance Act changes. One of the things the Finance Act has also done is the electronic money transfer levy collected should be distributed within 30 days following the month of collection. There's also that introduction that says the Minister of Finance would make regulations to cover any stamp duties and electronic money transfer levy collected between 2015 and 2019 when the Finance Act came up. Now, what you should note is that there is already some court disputes on this matter between the states and the federal government. And the fact that there was no clear court law between that 2015 and 2019 that covered this, as depicted by some judgments where it was actually ruled that the stamp duties imposed by, and collected at that period based on the CBN regulations were not legal. There's a lot of controversy around this. There's also the dispute where the states are saying that the banks cannot be collecting those funds and remitting it to, to the federation account on the basis that the Stamp Duties Act says that transactions between individuals should actually be payable to the states. And then it raised up the controversy of, when the bank collects funds where, someone is selling a shoe to another person and they're both individuals, should the banks be collecting the stamp duty on receipts in that case? Even though, one could argue that the receipt being issued by the person to his customer is different from the receipt being issued by the bank to its customer for the collection of money. The CIT exemption order 2011 expired 1st January 2022. So effective 2nd January 2022, the exemption of government securities from CIT no longer applies, except for bonds. So the exemption for federal government bonds continues to subsist, but the exemption for treasury bills and corporate bonds and even state bonds, the state bonds would need to get exemption under the Local Loans Act for them to benefit from any exemption. Now, one of the interesting things, at least for banks, is that FRS is going to be the primary agency for administering, assessing, collecting, and enforcing taxes and levies payable to the federal government. This is important because historically there have been all sorts of agencies, RMFAC, EFCC, police, Office of the Attorney General of the Federation, different people carrying out audits on this sector multiple times. So this provision would actually deal with that issue, because now it's only the FRS that is empowered to do that. But FRS may collaborate with other MDAs. Breaching this section, any officer that breaches this section is liable to a maximum of 5 years imprisonment and or 10 million naira. So they could actually be imprisoned and pay the 10 million naira. So if you're being harassed by multiple agencies going forward, you can easily just identify the name of that person, and seek enforcement of this provision. And this would actually add to ease of, doing business from this sector's perspective. So obviously, with all these changes, you need to stay ahead. Of course, there's multiplicity of taxes. You need to watch out for the effective tax rates and even the financial reporting for 31st December 2021. Some of these rates under IAS 12, which says that you use your deferred tax assets, would be based on the rates that have been substantively enacted. You need to also look at the financial reporting. One of the things this industry needs to watch out for and needs to take seriously is advocacy, because of inconsistency of application, as well as the potential of government continuing to issue and raise earmark taxes on this sector. So thank you. We'll take the conversation forward if you have questions and contributions and comments at this time. Thank you.
Thank you very much, Kenneth, for the insightful presentation. Well, whilst we were speaking, some very intriguing questions came through as well. The first one I would like you to address would be the effective date of the implementation of the increase of the tertiary education tax of 2.5%. Will it apply prospectively, or will it apply retrospectively to the 2021 financial year?
All right, thank you very much for that question. This question, I think, when the Finance Act 2019 happened, this question also came up in relation to minimum tax. If you remember at the time, the 25% imported equity exemption that used to apply for foreign-owned investments was removed. And companies had to answer the question, would it be applied to 2020 year of assessment, or would it be applied to 2020 financial year? And I think at the time we landed as, I would say most people landed on the fact that it had to be applied on 2020 year of assessment. Returns that were not yet filed as at the time the law came into force. So essentially, I think that would be the same rule would apply here. And the reason why that rule is applied in that way is because if you haven't really filed the return, you can't really make a strong argument for retrospective application, right? Of course, some people will say, if, it is retrospective on the basis that, if I had known, I would have planned for it during the financial year, which has already passed. But, what would you plan? Would you plan not to do business? It would be the next question. So, it is difficult to make an argument that it is retrospective and punitive from that sense. And then the second argument is that the government uses the Finance Act to fund the budget of the year. So Finance Act 2021 is used to fund the budget of 2020. So it just makes sense that the taxes that are going to be paid in Finance Act 2021 is used to fund the budget of 2022. So it just makes sense that it would apply to the taxes that would be due and collected in 2022. But having said that, there are other counter arguments, but the question would be, would there be critical mass in terms of an industry position where people say, we do not want it to apply in 2022 year of assessment. It should apply from 2022 financial year, which is 2023 year of assessment. So, those are some of the things that makes it difficult to apply, because even if you wanted to make the counter argument, which is slightly weaker, you would not have the critical mass joining you in that sort of dispute or litigation.
Thank you very much for that response, Kenneth. Right. So my second question is rooted in the clarifications the Finance Act has made to the minimum tax provision. So the next question from Ogumuyiwa here is just clarifying the applicable years, right, covered by the minimum tax change, right? Whether it's only applicable to 2019 or 2020, or is applicable to other financial years as well. Yeah, on mute, Kenneth.
So the reduced minimum tax rate covers 3 years, right? But you can only select 2 of those 3 years. So it covers from 1st January 2019 to 31st December 2021, right? So essentially, if you have, all financial banking and financial institutions all have 31st December year end. So you can select that, your financial year, 31st December 2019 and 31st December 2020. That is one selection. The other selection you can make is 31st December 2020 and 31st December 2021. That's the second selection. At your option, it's not at the option of the FRS. It's at the option of the company. So the company needs to do a simulation to compare the outcome of taking it in either of these 2 sets, these 2 pairs, and then file on that basis. So if you're a company with increasing revenue, the logic would be that you should take it for the later period, so 31st December 2020 and 31st December 2021. But for a company with alternating revenue, you need to do an analysis to compare the 2.
Thank you very much, Kenneth. The third question I have for you here, and I think this question has the context around given the expiration of the exemption order, given the applicability of CGT now to be applied on the sale of shares, Ogumuyiwa is asking if you can just give you some examples of non-taxable income now.
Okay, so for your industry, the obvious non-taxable income will be federal government bonds. So clearly that would still be non-taxable. And then if the state follows the procedures of the Local Loans Act and gets the exemption, in that process with, the debt management office and so on, then the state government bonds can be exempted. I do not see any other form of exempt income that companies in the banking and other financial services industry will be able to benefit from, except if you're in fintech. But the fintech cannot be sitting in a bank and you get the exemption. If you're in fintech and you set up a tech company separately, then you could get pioneer status. But pioneer status would be clearly for a pure fintech company starting, business, for the first time, and would only cover, 3 to 5 years based on the Industrial Development Income Tax Relief Act. So those are the scope of exemptions I see.
Yeah, I think I just add maybe one or two more. The first will just be capital gain on sale of shares that meet the exemption. So if you can meet those exemptions, then that would be exempt as well. Franked investment income. And I think one that also came true as well from the insurance space would be the investment income for life insurance businesses, investment income from investment on policyholders' funds, right? Given that the one for shareholders are taxable.
Yeah, thanks for plugging that. I appreciate. Yeah.
So Kenneth, the other question that we have here is around the scope of the penalties applicable to banks for not filing quarterly returns. Right. So the question from Bayo here is if it also applies to microfinance banks.
Sorry, take that again. I missed your connection.
Okay. So the Finance Act 2021 introduces penalties for banks who do not file quarterly returns.
Right.
Bayo is asking if the scope of that penalty also includes microfinance banks.
Yeah. So the definition of bank covers microfinance banks. It covers mortgage banks. So once you're a bank, then the penalties would apply to you. So the requirement to file the returns would apply to you, and then the requirement to if there are any penalties, it would also apply to you. So once you're a bank, as defined under BOFIA or the CBN regulations, then this applies to you straight away.
Thanks for the clarification, Kenneth. And I think the other question here that I would like you to touch on would be on the expansion of the FRS's powers to deploy technology in tax administration, right? Given that the Finance Act 2021 now allows the FRS to deploy third-party technologies, right, in the aid of their their functions, right? So how would you see the FRS apply this in practice? Who do you think are their targets? Do you think small and medium-scale companies should also be getting ready for these interactions with the FRS? And what recourse do you think the taxpayers have given the framework of the law?
All right. So the law is very clear. So the FRS can connect, technology to your systems for the purpose of assessment and collecting information. I think one of the limitations you can have is limitation of information that does not concern, tax collection and assessment. So you can resist from a legal perspective if FRS is trying to connect for other purposes apart from what they're primarily required to do. So that's one. The second thing you can challenge, and we've seen this happen with one of the technology that the FRS tried to deploy on a client. The FRS technical partner approached the company and said the company had to upgrade their system in order for them to connect their technology, and that the company would have to pay an annual license fee for that connection by FRS to continue to work. Now, if you have that sort of situation, you can clearly resist it because that's not what the law says. The law did not require you to spend or make investments in additional technology for the tax authorities to connect. The law just says you should allow them to connect within 30 days of writing to you. That does not require an upgrade. It does not require a license fee, other than what you are paying to your ERP technology vendor or so on. So if it's your normal costs should remain as they are. So if anybody needs to incur cost in order to build add-ons or in order to have some annual access, then it has to be the FRS or the technical partner eating that cost. So that's another resistance I think you can, or recourse that you can have if something like this pops up. Apart from that, there is not much in terms of challenge. The other bit that I think as an industry, you need to work on is, telling the FRS to implement risk-based auditing and give incentives for this connection. So what you see in other countries is that the FRS doesn't audit everybody. So when a company has already plugged in or allowed the FRS to plug into their system to get real-time information, then an audit is irrelevant. So in those countries, once you plug in, and allow the tax authorities to do that, then you'll be exempt from tax audits because you've already been audited. You're always being audited anyway. And then, the government can then focus on other taxpayers. But what you will see with this one is that, FRS will deploy this technology. You still need to file returns on Tax Pro Max, right? And then finally, you will still be audited, which, from all indications is not in line with ease of doing business. Will they do this for all companies? Knowing the FRS's normal approach, they would most likely target all companies. But what makes sense, as obviously that's what the reason why you're asking that question. What makes sense would be for them to limit the scope to big taxpayers, because that's what happens in other countries. So if they focus the technology on big taxpayers, where they do what we call cooperative compliance, where you're actually working with the tax authorities to have real-time monitoring of your tax compliance. Once you've done that, then there should be no audit. So government then focuses their efforts on the riskier sectors of the ecosystem. So looking at the informal sector, the smaller taxpayers, and the companies with poor corporate governance. So that would be the sort of structure, but it requires engagement and advocacy for the FRS to do any of that.
Thank you very much, Kenneth. And I think one last question that I would like to bring to your attention is on the gain on sale of shares and the applicability of withholding tax on interest paid to corporate bond holders going forward. What do you think is the role of double tax treaties on the applicability of withholding tax or capital gains tax, as the case may be?
So the treaties would be very much effective. So Nigeria's constitution has embedded in it the recognition of tax treaties. And the treaties are actually passed by the National Assembly, so they have force of law, just like CETA, that went through the National Assembly. A treaty goes through the National Assembly. So, this is like when two guys with equal strength meet themselves. And then CETA also acknowledges that the treaty overrides in Section 45. So when there is a treaty that allocates taxing rights, and not all treaties allocate taxing rights. So if I pick the South African treaty, for example, the South African treaty does not limit anybody's rights. It actually says that, the country where the company is registered, the country where the investor is resident may tax, but it doesn't limit the country of the investee company from taxing. So if you're using the South African treaty, for example, there'll be no protection. But if you're using the Singapore treaty, for example, says that the CGT will only be imposed in the country of residence of the investor. So if you're using the Singapore treaty, there'll be protection. So you need to analyze the treaty for CGT purposes. For withholding tax, there's already a procedure. The reduction in withholding tax rate to 7.5%. FRS came up with a procedure for applying the treaties. So you would need to go through that process in order to benefit from the 7.5% rate instead of the 10%. So that's it. Thank you.
Thank you very much, Kenneth. At this point, I'll hand over to Erikume.
Thank you very much, Kenneth. Thank you very much, Babatunde. This was very insightful. It was very engaging. It was very collaborative. We want to show our appreciation to everybody that asked questions. There was one thing that I failed to mention at the introduction, which was that this is not an all-comers affair. The invites were sent to specific people, and we are happy that you were able to join. There's a question that was not answered today. I think that question was from Mr. Ugumuyiwa Gafar. Please, we'll be happy to come back to you on that. We have to round up because of time. And in fact, any other questions, you can send it to the emails that sent you the invites or any of your contact persons here at PwC. With that, again, we'd like to thank you, and please go ahead and enjoy the rest of your day. Bye-bye.